Gold is on an absolute tear, and it feels like everyone is talking about it. So today, we're going to break down a strategic guide for navigating this booming market, especially as we look ahead to 2026. Let's dive right in.
So, why all the hype? What's the big deal? Well, get this. In just the last year, gold has delivered a stunning 27% return. Yeah, 27%. To put that in perspective for you, that's more than double the historical average of the stock market. A number like that is absolutely going to turn some heads and make gold the hot topic for investors.
But of course, that massive jump leads to the million-dollar question, right? After a run-up like that, is gold a bubble that's just waiting to pop, or is it somehow still a bargain for 2026? This is the core question, the big uncertainty we're going to unravel today.
To get to that answer, we really need to look past the recent excitement and understand the real foundation of gold's value. Why, after literally thousands of years, does this yellow metal still matter so much in our modern portfolios? You see, gold's appeal isn't some new trend. It was a trusted asset during the Roman Empire, the Spanish Empire, and the British Empire when they had the gold standard. And today, it's still seen as a safe haven. Superpowers change, currencies rise and fall, but gold has been this universally accepted store of value for centuries. It's why people instinctively flock to it when the world feels uncertain.
And this all comes down to one simple thing: scarcity. Governments can and do print more money whenever they want. That can devalue the cash in your pocket. But gold? You can't just print more gold. Its supply is finite. In fact, think about this. All the gold ever mined in history would barely fill 3 Olympic-sized swimming pools. That inherent scarcity is exactly what makes it such a powerful hedge against inflation. So let's be clear about gold's real job in your portfolio. It's not just about chasing these crazy high returns. It's really a defensive tool. It's your hedge against inflation, a safe harbor during global conflict, a diversifier that doesn't always move in lockstep with the stock market, and, of course, a timeless way to preserve wealth across generations.
Okay, so maybe you're convinced of the why, but what about the how? Let's map out the 5 main paths you can actually take to add gold to your portfolio.
All right, here are your options. You can go old school and buy physical gold, like bars and coins. You could use one of those app-based digital gold platforms. You can invest in gold exchange-traded funds, or ETFs. You could buy gold mutual funds, or, finally, you can look into government-issued sovereign gold bonds. Now let's compare these to find the smartest route for you.
And now it is time for the showdown. We're going to put the most popular methods head-to-head on the things that really matter for an investor: costs, convenience, and, of course, security.
Okay, let's break this down. Physical gold. It's what everyone thinks of first, right? But it comes with a lot of costs: making charges, taxes, storage fees, insurance. Plus, it's not exactly easy to sell in a hurry. Now, compare that to gold ETFs. The costs are way, way lower. They're highly regulated, and you can buy or sell them instantly, just like trading a stock. For most investors, ETFs are simply the smarter, more efficient choice, no question.
So what about those other 2 options? Well, digital gold is a bit of a Wild West. It's largely unregulated, and there's often a pretty big gap between the buying and selling price, which means you can lose money right off the bat. And sovereign gold bonds? They are fantastic. They even offer tax-free gains. But there's one tiny problem. They aren't being issued right now. It seems the government didn't quite expect the price of gold to shoot up so fast.
So, it looks like gold ETFs are the clear winner. But hang on, before you run off to buy one, there is a crucial insider tip you absolutely need to know. This can help you avoid a very common and very expensive mistake.
The secret is a little term called INAV, which stands for Indicative Net Asset Value. Just think of it as the true price of an ETF share based on the actual gold that the fund holds. The price you see flashing on your trading screen, the market price, can sometimes be very different from this true value.
So why does this matter so much? Well, just look at what happened with silver not too long ago. The actual price of silver fell by about 15%, but some silver ETFs, which had been bid way up by frenzied buyers to a huge premium over their INAV, they crashed by nearly 30%. When the hype disappeared, investors who had overpaid got hit twice as hard. Ouch.
So here's the bottom line, the big takeaway. Before you ever click that buy button on a gold ETF, do a quick online search for its current INAV. Seriously, this simple check takes seconds, and it ensures you're paying a fair price, not some inflated price driven by market mania. It protects you from buying into a mini bubble.
All right, we have covered the why, the how, and the what to avoid. So now let's pull it all together into a clear, actionable strategy for investing in gold for 2026.
First things first, allocation. The expert consensus isn't to go all in on gold. A disciplined, strategic approach means allocating about 5 to 10% of your total investment portfolio to gold. Remember, it's there for defense and diversification, not to bet the whole farm.
And please, I can't say this enough, do not chase those recent returns. That 27% gain was an outlier, a fantastic one, but an outlier. The realistic long-term historical return for gold over the last 65 years is more like 5.25% annually. That recent spike is going to average out eventually. Expecting 27% every year is just a recipe for disappointment.
So here it is, your simple 3-step plan. Step 1, define your allocation and stick to that disciplined 5 to 10% range. Step 2, for that allocation, choose gold ETFs as your primary tool. They're just the most efficient and low-cost option. And step 3, before you buy, always verify the value by checking the INAV. That's it, a simple, smart, and safe strategy.
And that really brings us to our final thought. You know, the smartest investors don't try to guess whether gold will go up or down next week. They use gold strategically. The real goal isn't about timing the market. It's about building a robust portfolio that's prepared for anything, one that can weather any storm the world throws at it. Thanks for joining us for this explainer.